What exactly is a yield curve? I mean, you hear about it on the financial news, CNBC, Bloomberg, Fox Business. They talk about the yield curve all the time. But what does it mean? Well, a yield curve is simply a graph of interest rates versus different maturities on various bonds. So if you picture a graph, you picture, it looks like this, right? And on the x-axis is certainly, the number of years, 5-year, 10-year, 20-year, 30-year. And the interest rates are up on the y-axis. And generally speaking, the yield curve goes up like this, which means that the longer term bonds you hold, the more interest you can expect to get. And intuitively, that makes sense, right? If you're going to tie your money up for 30 years, for a 30-year bond versus 5 years, you want to get more interest rate. And the issuer of the bond should need to entice you to buy a longer term bond and make a longer term time commitment with a higher interest rate, right? And that's called a positive sloping yield curve. Because again, if you look at the graph, the curve is coming up like this. When yield curves start to be discussed a lot in the financial news is when we talk about a flattening yield curve. When that yield curve starts to come down, where the long-term interest rates are paying maybe just a little bit more than short-term interest rates, or even worse, they're flat. It's a flat yield curve where long-term interest rates and short-term rates are the same. Think about it. You buy a 10-year CD, you want to earn more interest than a 1-year CD. Well, if you're not, if it's the same rate, what does that mean? It means that the smart people in the economy, in the financial markets, are predicting a downturn in the future. And they're predicting future interest rates are going to be lower. And that's why the yield curve is flattened out. In fact, one of the best indicators for recession is a flat yield curve, or even worse, an inverted yield curve, where long-term rates are actually lower than short-term rates. So if you start to see a 30-year bond yield get down to what maybe the interest rate on a 10-year bond is, or even lower than a 10-year bond, that's a very good sign of an upcoming recession. So again, just a fancy term. Wall Street loves to use these fancy terms for how to graph the difference between long-term interest rates versus short-term interest rates.